Hello, my dear students. A very warm welcome to all of you in Shri Jaindra Rank Zone. I am your friend and mentor for this subject, Principles and Practices of Accounting. In this lecture, we'll continue with Chapter 4, that is Inventories. All the concepts will be covered in the coming series of lectures. Let us continue. This is lecture number 6. Let us continue with illustration number 9. Let us read this illustration first. Inventories taking for the year ended 31st March 2016 was completed by 10th April 2016, the valuation of which showed a inventory figure of 16,75,000 at cost as on the completion date. After the end of the accounting year and till the date of completion of inventory taking, sales for the next year is 68,750. The profit margin being 33.33% on cost. My dear students, this is the sales figure. This is the sales figure and the profit margin is 33.33% on cost. So we have to convert this on sales. So 33.33% on cost equals 25% on sales. 25% on sales. Purchases for the year included in the inventory amounted to 90,000, but this 90,000 is at cost less trade discount is 10%. So from this 90,000, the trade discount of 10%, that is 9,000, needs to be deducted. That would lead us to 81,000, and that would be the purchase for the next year. The net purchases for the next year would be 90,000 minus purchase return 9,000 equals to 81,000. During this period, goods were added to inventory at a markup price of 300 in respect of the sales return. So this figure of sales return is at the markup price. Markup price means the profit percentage is already added to this. If we'll calculate the cost of it, you should understand one thing over here, that so this figure of 3,000 is at selling price. If you want to find out the cost price over here, so this 3,000 would be 100 and cost is 25% less, so 75. We need to find out this figure. So this would be 2250. 2250. 3,000 multiplied by 100 divided by 3,000 multiplied by 75 divided by 100 equals 2250. Let us continue. After inventory taking, it was found that there was a certain very old slow moving machinery of 11,250, very slow moving machinery, which should be taken at 5,250 to ensure disposal at an interested customer. So there is a loss in the value of 6,000, that is 11,250 minus 5,250, and that loss in the valuation of slow moving inventories would be recorded over here. Fine. So due to the heavy flood, certain goods costing 15,500 were received from the supplier beyond the delivery date of customer, and as a result the customer refused to take the delivery. And the NRV of that good was 12,500. So again over here there is a reduction in the value of 3,000, as you can see, because of the delayed delivery. 15,500 was the earlier prescribed amount, but now the net amount is 12,500. So there is a loss and reduction in the value of the inventory because of the delayed delivery, and that is 3,000. I believe you understood. Compute the value of inventory for inclusion in the final accounts for the year ended 30th March 2016. I believe it is clear to all of you. Let us try to solve it now. Statement showing valuation of inventories as on 31st March 2016. Okay. Let us make the statement. Particulars amount. First of all, we will record this value, that is the value of inventory. The value of inventory on 10th April. Please write over here. Value of inventory. Value of inventory as on 10th April. 10th April 16 lakh 75,000. We need to add the cost of it. So we'll be adding and deducting the 33% on sales, that is 25% on cost. So just write over here, add cost of goods sold after 31st March till inventory taking date, till inventory taking, the value was 68,750, 68,750 minus 68,750. So we need to calculate. I'm calculating it over here. 68,750. This is 100%. What would be the 75%? 675 multiplied by 68,750 multiplied by 100. This would be 51,560. So 51,560. This amount would be deducted. Let me correct this amount. 51,560. So the final amount over here would be 51,560. The final amount over here will be 51,560. 68,750 minus 51,560. This is 75%, and over here we need to deduct 25%. So we can calculate in this manner also. 68,750 is 100%. What would be the 25%? 25 multiplied by 68,750 divided by 100. So this would be 17,190. Over here 17,190. Is it clear till here? Now we need to deduct the purchases for the next period. What is the purchases for the next period? Purchases for the next year included is 90,000 and 10% is trade discount. Just write purchases for the next period, next year, 90,000 minus purchase return 10%, 9,000. 90,000 minus 9,000. It would be 81,000. Understood? During the year, goods were added to inventory at a markup price of 3,000. Markup price of 3,000. So we need to deduct the profit percentage and we need to bring it at cost. So if 3,000 is 100% and that is at markup price, if this 3,000 is 100%, what would be the value of 75%? So 75 multiplied by 3,000 divided by 100, 2250. 2250. So we need to deduct 2250 from here. 2250, just write less cost of sales return, cost of sales return, 3,000 is 100, 75 is what? So we have calculated it, 2250. 2250. Next transaction. After inventory taking is what found that there was a certain very old, slow moving costing inventory 11,250 which should be taken at 5250. So there is a loss of 6,000 over here. The slow moving inventory loss is 6,000 less loss on loss on revaluation, loss on revaluation of slow moving inventories, slow moving inventories. The loss is 6,000. How we found this 6,000? 11,250 minus 5250. 11,250 minus 5250. Understood? Apart from this, there is a loss. There is a loss because the NRV of this 15,500 was the cost, but the NRV is 12,500, so loss is 3,000. We need to record this also. Write less reduction in value on account of default. What is the two values? 15,500, 12,500. 15,500 minus 12,500. So 3,000 loss is 3,000. Kindly solve it. Solve it. 16,75,000 plus 55,560 minus 81,000 minus 2250 minus 6,000 minus 3,000. 16,34,310. Value of inventory, value of inventory on 31st March. Value of inventory on 31st March 2016. 2016. Okay. Write a note over here. Profit margin. Profit margin of 33% on cost equals 25% on sales price. 25% on sales price. 25% on sales price. Okay. Let us continue and see illustration number 10. Illustration number 10. The following are the details of spare parts of Shriram Mills. 1st January 2016, the opening inventory is 10,000. 1st January 2016, there is a purchase of 100 units at 30 per unit. 15 January 2016, issued for consumption 50 units. 1st February 2016, purchases is 200 units at 40 rupees per unit. 15 February 2016, issued for consumption 100 units, and 20th February 2016, issued for consumption is 100 units. Find out the value of inventory as on 31st March 2016 if the company follows FIFO. If the company follows FIFO. Let us try to solve this. Write over here solution FIFO, first in first out basis. FIFO, Shri Ram Mills calculation of the value of inventory as on 31st March 2016. 31st March 2016. Make the chart along with me. Three big columns. First, receipts. First is receipts. Then we have issues. And at last we have balance amount. First is date. Then there would be three columns. The first is units, quantity, rate, amount. Quantity, rate, amount. Quantity, rate, amount. Let us begin from 1st January 2016. Opening inventory is nil. So we will write over here January 1st, January 2016. First, unit is 0. So balance over here is 0. Again, there is a 1st January 2016 purchases 100 units at 100 units at 30 per unit. 1st January unit is 100, rate is 30. 30 multiplied by 100 equals to 3000. Issue is nothing. The balance is 100, 30, 3000. 15 January issued 50 units. 15 January issued 50 units, 50. Out of this 150 is issued, so 50 would be the balance. Quite simple. 50 issued, so 50 would be the balance. 15 January, over here 50 is the issue at 30. 50 multiplied by 30 is 1500 would be the amount. 1500 would be the amount. The balance would be 50 units at the rate of 30, 1500. 1st February there is a purchase of 200 units at 40. At 1st February the purchase of 200 units at 40. 200 multiplied by 40 is 8000. Issues is nothing. Now the balance is 50, 30, 1500. This we already have. Now the new balance is 200 at 40 rupees, 800. I believe you understood. 1st February, then 15th February issue 100 units. 15 February issue 100 units. From this 200, 100 units is issued. So as per the FIFO method, we need to issue 100 units, but 100 unit would be not issued like this. 50 at the rate of 30 and 1500 this would be issued, and then 50 from this 200 will be issued. I believe you are 50, 30, 1500 would be issued. This 50 is gone. So from this 200 we will issue 50, 40, 50 multiplied by 40. 50 multiplied by 40 is 2000. Now over here what would be the balance? The balance would be 150. The balance would be 150, 40. 150 multiplied by 40 is 6000. 150 multiplied by 40 is 6000. This would be the balance. Now again we need to issue. We need to issue 20th February issue for consumption 100 units. 20 February 100 units. So 20th February 100 units. Now we have only one stock. This is 150 units, so we will issue 100 units out of this. So 100 units, 40, 4000. From this 150, 100 is issued, so the remaining is 50 multiplied by 40 equals 2000. This is the value of inventory, 2000. We can write over here, therefore the value of inventory, therefore the value of inventory as on 31st March 2016 equals 50 units at the rate rupee 40. 50 multiplied 40 is rupee 2000. Rupee 2000. Understood? Okay. I believe all of you are clear till here. Let us continue and solve illustration number 11. Let us continue and solve illustration number 11. The following are the details of a spare parts of Shriram Mills. First, January 2016, the opening inventory is nil. 1st January 2016, there is a purchase of 100 units at 30 per unit. 15th January 2016, issue for consumption is 50 units. 1st February 2016, purchases is 200 units at 40 per unit. 15 February 2016, issues for consumption is 100 units, and 20th January 2016, issues for consumption is 100 units. Find out the value of inventory as on 30th March 2016 if the company will follow weighted average price method. Weighted average price method. So we need to solve this sum with weighted average price method. Let us try and do it. Right, solution. Solution. Weighted average average price method. Shriram Mills. Calculation of the value of inventory. Calculation of the value of inventory as on 31st March 2016. Make this table for weighted average price method. Divide into three parts. First part is receipts. Then we have issues, and at last balances. Four columns inclusive of date, quantity, rate, amount. Quantity, rate, amount. Over here also, quantity, rate, and amount. We will begin with January 1st. January 2016. 1st January 2016. The balance is nil. Then again, 1st January 2016, purchases of 100 units at 30. Purchases of 100 units, the rate is 30. So amount is 3000. No issues. Balance 100, 30, 3000. Now, issue for 15 January, issue for consumption 50 units. 15 January, issue for consumption 50 units. 15 January, Issue for consumption is 5050 units. The rate would be 30, 1500. So from 100 we got 50. The balance is 50, 30, 1500. If you got it, it's good. If you understood, it's good. I believe it is fine till 15 January. 1st February there is a purchases of 200 units at 40 rupees per unit. 1st Feb purchases of 200 units at 40 rupees per unit, 8,000. The quantity would be nothing over here, issues. Okay, so purchases. So we need to add. So we already have 50. Now this 200, 50 plus 200. Final balance would be 250. Final amount 8,000 plus 1500, 9,500 we had added, and now divide 9,500 by 250. 9,500 divided by 250, we will get this rate, the average rate 38. We got this average rate, that is 38 on 1st of Feb. Let's move 15th Feb now. 15th Feb, issues for consumption 100 units. Issues for consumption 100 units. 100 units from which this one only. So 38, 3800. Issues for consumption 100 units. So 250, 100 unit is gone. 150 is balance of 38. 150 multiplied by 38 is 5700. 5700. Let's move ahead. 20th February issued for consumption 100 units. 20th February issued for consumption 100 units. 100 units from this only. So the rate would be 38, 3,800. The balance is 150 minus 100. The balance is 50 of 38. 50 multiplied by 38 is 1,900. 1,900. So this would be the value 1,900 as per weighted average, and as per FIFO we got the value as 2,000 in illustration 10. Right now we are doing illustration 11, and the final value we received is 1900. Right over here, therefore the value of inventory as on 31st March 2016 equals 50 units, 50 units at the rate 38 rupees, that is equals 1900. That is equals 1900. Is it fair? Is it clear to all of you? So this is done. Illustration 11. Let us write an example. Let us write an example. A company, a company, a company started on April 1st, 2017, purchased raw materials, purchased raw material So raw material during during 2017 and 2018 as stated below as stated below. Write along with me. On April 2, 800 kgs of raw materials, so kgs is unit over here, at the rate rupee 62 per kg, rupee 62 per kg. On May 26, 1200 kgs of material at the rate 57 per kg, 57 per kg. On July 13, July 13, 2500 kgs of raw material at 59 per kg. On October 10, 3000 kgs of material at the rate 56 per kg, at the rate 56 per kg. December 18, December 18, 1500 kgs of material at the rate rupee 60 per kg. December 18, 1500 kg of material at rupee 60 per kg. February 29, February 29, 1000 kgs of raw material at the rate 65 per kg. 1000 kgs of raw material at the rate 65 per kg. Understood? While while preparing while preparing its final account while preparing its final accounts on March 31st, 2018, the company had 1300 kg of 1300 kgs of raw material 1300 kgs of raw material in its godown. So while preparing its final account on March 31, 2018, the company had 1300 kg of raw material in its own godown. Let us continue. Right. Calculate the value of closing stock. Calculate the value of closing stock of raw materials according to first first in first out basis, that is FIFO. Second, last in first out basis, that is LIFO. Last in first out basis, that is LIFO. And third, weighted average basis. Weighted average basis. I believe you understood the question. So this is the example that we need to solve. Let us begin with the first method, and that is FIFO. That is first in, first out. Right, solution. Right, solution. Solution. Valuation of valuation of closing stock as per FIFO basis. As per FIFO basis. As per FIFO basis. Particulars. Particulars and amount. Let's try and understand how we'll solve it as per FIFO basis. How we will solve it as per FIFO basis. So students, if you had read the question over here, it is clearly mentioned that in the closing inventory we have only 1300 kgs of raw material left. In the closing inventory we have only 1300 kgs of raw material left in the godown. So as per first in, first out, the latest material would be available. So 1000 kgs at the rate of 65 and 1300. So 300 would be taken from 18 December. That is from this 1500 kgs. We have to take 300 kgs. So 300 kgs at 60 per kg. And likewise, we'll be able to do calculate for the FIFO. Right. 1000 kgs of raw material at rupee 65 per kg, at rupee 65 per kg. Let us do it by LIFO method now. LIFO, last in, first out. Point number 2. Valuation of closing inventory. Valuation of closing inventory or closing stock as per LIFO method, last in, first out, as per LIFO method, that is last in, first out. Particulars, particulars amount, particulars amount, total 1300 is there in the closing stock. 1300 is there in the closing stock. So as per LIFO, the oldest would be there in the closing stock because every material is purchased. So 800 multiplied by 62 and 13 minus 800, that is 500, would be of 57 per kg. That would be from May 26. Out of the 1200 kgs, the 500 would come under LIFO method. Let us do the recordings. So we will write 800 kg. We will write 800 kgs at the rate 62 per kg, 49,600. 800 multiplied by 62, 49,600. And 500 kgs, and 500 kgs would be from 500 kgs would be from 57 per kg, 57 per kg. So 500 multiplied by 57 is 28,500. 28,500. 49,600 plus 28,500 equals 49,600 plus 28,500 equals 78,100, and this would be the value of closing inventory as per LIFO. Value of closing inventory as per LIFO method, as we have mentioned here. Now the third method is weighted average method. Weighted average method. Let us begin with weighted average method. Just write over here valuation of inventory, valuation of inventory as per weighted average method. Weighted average method. Let us make the table. Let us make the table. We will record date of purchase first. Second column, we will record price, units, that is quantity, and then we will do the total, that is amount. Quantity, rate, amount. Date of purchase. So first of all, the date of purchase is, the first date of purchase is 2nd April, 800 at 62. 800 units at 62. April 2, 2017. Quantity is 800 units. Rate is 62. 800 multiplied by 62 is 49,600. Let us continue. The next date is May 26. May 26, 1200 kgs at 57. May 26, 2017, 1200 kgs at 57. The amount is 68,400. July 13, 2500 kgs at 59. July 13, 2500 kgs at 59. 59 multiplied by 2500 equals 147,500. 147,500. The next is October 10. October 10, 3000 kgs at 56. October 10, 3000 kgs at 56. 3000 multiplied by 56, 1,68,000. December 18, 1500 kgs at 60. December 18, 1500 units at 60. 90,000. 90,000. The next is February 29, 1000 kgs at 65. February 29, February 29, 1000 kgs at 65. So 1000 multiplied by 65 equals 65,000. Okay, let us do a total of quantity. Total of quantity 800 plus 1200 plus 2500 plus 3000 plus 1500 plus 1000 equal to 10,000. Let's do a total of amount column. A total of amount column, that is 49,600, 68,400 plus 1,47,500 plus 1,68,000 plus 90,000 plus 65,000 equals 5,88,500. 5,88,500. We have to calculate the weighted average price. Right over here, average weighted average price equals 5,88,500 divided by number of units, which is 10,000, equals 58.85 rupees per kg. I believe you have understood till here. Let us continue and write value of closing stock. Value of closing stock equals 1300 kgs multiplied by 58.85. 58.85. So the total amount is 76,505. The total amount is 76,505 rupees. This is the value of closing stock as per the weighted average price method. The weighted average price method. I believe you have understood till here. Okay, so let us move ahead. Let us move ahead. Okay, so just write from here. Just write what are the disclosure requirements. What are the disclosure requirements? What are the disclosure requirements as per Accounting Standard 2? As per AS2. Okay, so disclosure as per Accounting Standard 2. The first disclosure is accounting policies. First of all, we need to disclose what? Accounting policies that has been followed in the valuation of inventory. The second policy is cost formula used. Cost formula. Cost formula used. The third is total carrying amount of inventories. Total carrying amount of inventories. And classification of amount of inventories. Classification of amount of inventories. These things should be disclosed as per Accounting Standard 2. Kindly note in your notebook quickly. First is accounting policy, cost formula used. Third is total carrying amount of inventories. And the fourth is classification of amount of inventories. Let us move ahead now. Let us move ahead. The next topic is, just write this theory: adjusted selling price, adjusted selling price or retail inventory method, or retail inventory method. First, according to accounting standard 2, according to accounting standard 2, this method this method may be used in this method may be used in retail businesses or in business where the inventory where the inventory comprises of comprises the items, the individual costs the individual cost of which are not readily ascertainable not readily ascertainable. I believe you understood the first point. Let us write point number 2. Point number 2: the cost of the inventory is determined the cost of the inventory is determined by reducing the estimated percentage reducing the estimated percentage of of gross margin from the sales value from the sales value of the inventory. Next point. Next point. The calculation of the calculation of the calculation of the estimated gross margin of profits may be made for individual items or groups of items or by departments as may be appropriate to the circumstances. This method this method this method is also used by this method is also used by some manufacturing this method is also used by some manufacturing organizations for valuing the inventory of finished goods valuing the inventory of finished goods or finished products held against held against forward sale contracts, held again forward sale contracts. I believe it is clear till here. I believe it is fine. Just write AS2 deals with valuation of inventories. AS2 deals with valuation of inventories. Cost formula, cost formula permit, cost formula permits number one, FIFO, number one, FIFO, number two, weighted average, weighted average, weighted average. How do we calculate cost of sales? How do we calculate cost of sales? So generally, opening stock or opening inventory is known. Opening stock or opening inventory is known, plus purchases is known. Purchases is known to us, minus closing stock, that is closing inventory. Generally we determine it, and then what we get is cost of sales. Then what we get is cost of sales. Let's write inventory record system. Inventory record system. The first inventory record system is periodic inventory system. Periodic inventory system. Students, periodic inventory system means physical counting. It means physical counting. And how it should be done? Like this. Opening stock we already know. Purchases we already know. Closing stock we will count and determine. Determine by counting. Determine by counting. Physical counting. Physical counting. And then we ascertain the cost of sales. Understood? The second is perpetual inventory system. The second is perpetual inventory system. Perpetual inventory system on the basis of recording. How we do the recording? So whenever we receipt, we record purchase. Whenever we receipt, we record purchase. Whenever there is an issue, we record sale. Whenever there is an issue, we record sale. Or it could be consumption. Or it could be consumption. Consumption. And at last, we have balance. Whatever is the balance will be treated as closing. Whatever is the balance will be treated as closing. My dear students, perpetual inventory system is an expensive method of recording inventory. Just write over here. Perpetual inventory system. Perpetual inventory system is a expensive is a expensive method of recording inventory, of recording inventory, but this is a this is a better system, better system and more accurate system of recording inventory, of recording inventory as compared with, as compared to periodic periodic inventory system. Periodic inventory system. I believe you understood till here. I believe you understood till here. Okay, so we are stopping here. We'll continue in the next class now. Thank you.